Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's video insight. There are three basic building blocks in generating a valuation on a company: the forecast rate of earnings growth, the return the company can generate on incremental capital invested in the business, and the risk-adjusted rate of return required by the investor, also known as the cost of capital. Recent market gyrations have been driven by a number of factors. One of these is the apparent turn in the long-term bull market for government bonds. 10-year government bond yields in the US appear to have bottomed in July 2016, reaching a low of 1.36%. Since then, yields have more than doubled and currently sit above 3% at present. Australian government 10-year bond yields have also bottomed around the same time at about 1.82%, and they have since increased to around 2.7%. So why is this important for stocks? We can think about the risk-adjusted cost of capital for a stock as being a combination of the required return on riskless assets, like government bonds, plus a risk premium. Therefore, a change in the return generated on bonds impacts the return investors require from equity instruments. This makes sense in that investors look at a broad range of investment opportunities. If the returns being generated in one asset class increase relative to another, then investors are likely to move money to that investment class as it has become relatively more attractive. Selling equities to buy bonds due to the higher yield being offered puts downward pressure on share prices and improves the future return on those equities from the new lower price level. However, in the case of equity valuations, not all changes in government bond yields are equal. Government bonds are nominal securities, with the returns received by holders in the form of coupons and the return of the face value at maturity being fixed amounts. Equities and other investment assets like property are what is known as real securities. This means that if the rate of inflation increases, the holders of the asset can generally expect the return to increase as well. In the case of equities, rising inflation means that prices charged by the company, as well as its costs, tend to increase at a faster rate. This results in a change in the rate of earnings growth. In this environment, it's important to assess the pricing power of the business so that you can be confident the company can pass on any acceleration in cost growth to its customers. This will lead to an acceleration in earnings growth, offsetting the negative impact of an increase in the cost of capital resulting from an inflation-driven increase in government bond yields. Equity valuations are extremely sensitive to the movement in the real bond yield. This is the component of the bond yield excluding the expected level of inflation over the life of the bond. To provide an indication of this sensitivity, a 1 percentage point change in real yield impacts the average equity valuation by about 25 to 30%. So the issue regarding the impact of rising bond yields on the valuation of equities should really be whether the increase reflects higher inflation expectations or is it an increase in real yields. This is a difficult question to answer because the market's expectations for inflation over the next 10 years is difficult to determine. Quite often the real yield is discussed in terms of the difference between the current level of inflation and the nominal yield. But this will overstate real yields if inflation is expected to accelerate in coming years, as is the case at present. Index-linked bonds provide some indication of real yields, as the coupon they pay is adjusted for changes in inflation. Australian index bond yields have increased by around 65 basis points since their lows in August 2016. This accounts for most of the increase in the Australian government 10-year bond yield over the same period. Increases in index bond yields in the US would suggest around half the increase in the US 10-year government bond yield is due to an increase in real interest rates, and the other half from increased inflation expectations. With the real bond yields increasing materially from very low levels, there should be downward pressure on valuations in the market as bond returns become relatively more attractive. This has been offset by strengthening earnings growth over the last 12 months. However, if the outlook for earnings growth becomes more uncertain, capital rotation is likely to occur quickly, causing ongoing volatility in equity markets. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.